In this video, we break down the critical defense mechanics required to manage a short straddle. A short straddle is a neutral strategy that profits from time decay and crushing implied volatility. However, because you are short both in at-the-money call and put, you have negative convexity. Any significant move in the underlying asset immediately threatens your profitability. Survival depends not on the entry, but on how you react when the market challenges your break-even points. The first line of defense is a mechanical stop-loss based on premium expansion. A common discipline is to close the trade if the current value of the straddle expands to 1.5 or 2 times the initial credit received. While taking a loss is painful, this prevents a manageable drawdown from becoming a catastrophic tail risk event that wipes out months of gains. If the move is more gradual, we adjust by rolling the untested side. If the market rallies, your short put loses value. You can roll this put up closer to the stock price to collect additional credit. This reduces your net delta exposure and widens your break-even points. Though be careful not to roll so aggressively that you lock in a guaranteed loss by inverting the strikes. For advanced portfolios, we can neutralize directional risk through dynamic delta hedging with the underlying stock. If a rally makes your straddle highly short delta, buying shares in the underlying asset brings your net delta back to zero. This isolates the position as a pure volatility play, allowing you to survive the directional move while waiting for theta to decay. Finally, recognize when the risk profile no longer suits the market environment. If volatility explodes unexpectedly, converting the undefined risk straddle into an iron fly by buying wings defines your maximum loss. Remember, in options selling, capital preservation is the prerequisite for long-term compounding. Apply these defenses to stay solvent, and thanks for watching.